Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. On this podcast, we're taking a rigorous look at the developed markets. It's August 13th, 2024. Our guest today is Jillian Wolfe, CFA. She is a global equity strategist for Bloomberg Intelligence. Prior to her role at Bloomberg, Jillian was an investment strategist at JP Morgan Asset Management, where she commented on the U.S. equity market and economic trends for wealthy clients. Jillian got her bachelor's degree at Johns Hopkins. So welcome to the podcast.
Thank you. Thanks for having me.
So let's go right to the most important thing I think is on a lot of people's minds still, although it's been like a year now. U.S. CPI has been stuck in the 3 to 3.5% range for ever, or at least a year. How do you think the U.S. equity market is adapting to that growth rate, and how do you think it will going forward?
We're definitely in a novel regime right now. The idea that CPI may not return to the Fed's target of 2% really anytime soon has seemed to be baked into the market, the equity market itself, as well as expectations for Fed rate cuts. What we have found actually impacts the equity market itself more is not CPI levels itself or the rate at which CPI is accelerating. It's the rate at which CPI accelerates relative to PPI. That's producer price index growth. For a decent amount of time in 2022, producer prices were increasing much more rapidly than consumer prices. That really starts to compress operating margins, particularly operating margin expectations, which we've seen have a direct correlation to market performance. That recently flipped in recent months. We now have consumer prices rising much faster than producer prices, although the spread between the two has come down a little bit from their peaks. But so long as companies can continue to pass on these higher costs to the consumer, we don't necessarily see a slightly higher 3 to 4% CPI regime in the intermediate term as necessarily problematic for the U.S. equity market, so long as producer prices don't start to pick up faster.
Right, and the pass-through keeps going on.
Exactly.
I guess I'm always kind of interested in how people determine when that has reached the point of no return, when the consumer will say enough is enough on prices and start to ratchet back consumption, or, companies will do the same thing.
There's a lot of focus right now on the consumer health.
Mm-hmm.
A lot of fear, it seemed, really since 2020, since the start of the pandemic, that the consumer was going to give way at some point. And we haven't really seen that happen. Common stat that people seem to be worried about is low savings rates. The saving rate is coming down quite significantly. And we think this is a bit of a faulty measure to determine how much consumers are actually willing to spend. The savings rate really just tells you how much money a consumer has put aside each month after paying down their expenses.
Right.
When we look at the actual cash balance of the U.S. balance sheet of U.S. households, it's near record highs.
Mm-hmm.
Consumers have not really drawn down significantly on their COVID savings just yet. There's still a lot in their back pocket that they can use to spend. So the idea that they could turn over sometime soon, we haven't really seen that weakness quite yet. Another metric that looks really strong is debt service ratios and debt to disposable income. We live in a country where you can get a 30-year fixed mortgage. So we're seeing something very different play out in Canada, play out in Europe, where the mortgage rates reset every 5 years. In the U.S., if you got a mortgage anytime between 2010, 2021, you could be paying as low as 3-4% on that mortgage. You haven't really felt the impact of these rising rates quite yet. So the consumer is quite healthy. The flip side to that is that because we have this mortgage system in the U.S., it takes a longer time for the impact of policy to flow through. Consumers will keep spending. The majority of their debt is held in mortgages. It's not actually held necessarily in consumer credit. So they're likely to keep spending for some time. We're not seeing a slowdown. And as a result of that, that's why CPI really might have trouble coming down to that 2% level the Fed's been struggling to get it to.
Yeah, it's fascinating. I have one of those mortgages. I'm glad to say I was lucky enough to not quite refinance at the bottom, but pretty darn close.
Pretty close, yeah.
And now that we're near the end of it, I keep thinking, can I put the brakes on this somehow?
I know. I'm looking at how much it costs to get a mortgage now. It's like 7% if you're lucky.
Well, I don't even want a new one. I just don't want to pay it down because I want to keep the money in the mortgage and not in the market, out of the mortgage in the market.
Exactly.
And it's pretty attractive. Well, so let's talk a little bit about, I do want to get to Canada in a second because that's an exceptionally interesting place, getting more interesting by the day, I guess. But let's talk about the trading cycle in the U.S. because this is really where a lot of things are going sideways, so to speak. We've got subsectors that go in opposite directions all the time now. Home builders go here, superconductors go there. So where do you think we are in the trading cycle?
What we've noticed, at least since the start of this half of the year, is we're in a quite rate sensitive time of the trading cycle. So normally early on, when you're expecting more of an economic recovery, you have leading indicators like semiconductors, like home builders, like transport, all moving up together. We've seen some wobbliness between these three throughout the first half of the year. You had this big rally in semiconductors. Home builders were pretty flat. Transports were underperforming the broad market. We've sort of seen a complete reversal of the semiconductor industry right now. Still up year to date, but definitely since the start of this quarter, not doing well. Home builders have really rallied on the expectation that rates are going to start to come down. They've outperformed the market pretty significantly, the S&P 500 at least, in the past 6 weeks as we're recording this. And transports still continue to lag a little bit. So we're not seeing this ebullience in these leading indicators consistently at all this year. And even now, we've just seen a rotation between them into a more rate-sensitive trade.
Okay, that is interesting. Well, let's get on to Canada now because
Sure.
in the last week we've seen that Canada, which I think a lot of people think of as a steady eddy that
Hmm.
doesn't change very quickly, especially socially,
Oh, yeah.
has seen one of the more breathtaking rapid increases
Hmm.
in skepticism, let's call it, about the immigration model.
Yes.
But I don't want to. That's not this type of podcast. We're here to talk about Canadian equities. It's just an impact. It's just like a signpost of how things are changing
Yeah.
there. You've written a lot about the impact of the gold spot, which is natural for them. So, do you think we've reached a point where the Canadian equities earnings are going to pick back up, or what do you see next in there?
People think of, like you said, Canada, this boring market. It's a bunch of banks, it's a bunch of energy materials companies. We have all these exciting developments in AI in the US. Why would you care about Canada? But Canada was the best performing market in July
Yes.
of the 23 major markets. It hit a new high. The first half of the year has done far better than the US since the end of June. Part of this is because that market and these beaten down, more value centric, material oriented, energy oriented markets, in this latest reversal where some skepticism is coming up around AI and we really have stellar growth in the gold spot, you're
Yeah.
really starting to see Canadian equities shine as a result of that. Canada had the best performing materials sector in the developed world year to date. It still does because they're so heavily exposed to gold. If you just track how the Canadian TSX index behaves relative to gold spot, it peaks when gold peaks,
Yeah.
it troughs when gold
Yeah.
bottoms. People really think of this as a safe gold market. And right now you have gold spots still near record highs. The market itself has been in an earnings contraction for the past 5 or 6 quarters, really difficult comparables on the commodities, on energy, on materials. They're finally starting to turn around. You have Barrick Gold reaching, really exceeding expectations for growth on the earnings front. And you have this materials sector, which is rather large in Canada. And the S&P 500 doesn't make up that much of the index. It
Right.
makes up 2 or 3%. It's about 10% of the Canadian index.
Oh, okay.
Really starting to lift the index as a whole. And it's something we're keeping an eye on as the earnings start to turn around in Canada. And they actually start to slow a bit in the US on the back of some of this AI deceleration. The peak in AI earnings may have been past us. So I think investors are going to start to look for, well, where is the growth headed? And some of these more material-centric markets are important. I can actually comment a little bit about immigration just from a strictly non-political standpoint because we've...
Sure, but I just want to clarify one
Of
thing
course.
because people use this term differently. I just want to make sure people on the podcast understand it.
Sure.
When you talk about, sort of the updraft from AI,
Mhm.
you're not just talking about the AI companies, or you're also talking about chip makers and the other stuff that give
Yes.
electricity providers. Everything goes into it, or
Mhm. So Bloomberg, we run at Bloomberg what we call our artificial intelligence theme basket. This is anything that touches AI. So it doesn't currently include the electric providers, the utilities, but it includes the chip makers. It includes anyone involved in R&D.
Mhm.
It includes even companies like Shopify, like Alibaba, that are able
rely
to
on it.
use
Yeah.
and leverage AI to help grow their platforms. So we're not just talking about the NVIDIAs, the Metas, the ASMLs. we're talking about anything that AI really could touch in the near term.
Thank you. That's exceptionally important too, because people talk about that in different ways. And I just want
Of
to make
course,
sure.
no, I should clarify that we're not just talking about those small handful of big companies that are really leading the development and R&D right now.
Okay, so now let's talk about the second most interesting thing I think has happened in Canadian social scenes
Hmm.
since they had the big truck strike,
Yeah.
which I also thought was like shocking.
Hmm.
This has been shocking. So what do you think?
So Canada's really implemented this really aggressive immigration program to allow skilled workers,
Mhm.
particularly students,
Yep.
into the nation,
Yep.
partially because their birth rate has fallen below the replacement rate.
Right.
This is true in many developed countries, and because the country itself has historically struggled with low productivity.
Mhm.
That's the amount of output per laborer.
Yep.
It's a structural problem in Canada. They're a very large country that have a lot of small to mid-sized businesses that struggle to take advantage of economies of scale. So the government's solution was, if we have low labor productivity, how do we fix this? How do we boost our economy? Well, we bring in more laborers. What's happened, and we've seen this reflected in a little bit of equity volatility, is there has not been enough investment in industry to actually give all these new immigrants jobs. For a while in 2021 and 2022, there were more job openings than job seekers. That was actually putting a decent amount of upward pressure on wages. Now that's flipped. Now there's far more job seekers than there are openings, and that's caused definitely frustration amongst Canadian citizens, and it's also caused some concerns that this Hail Mary to get the economy back on track to boost GDP isn't really playing out the way the government wanted to. And I think that's one of the biggest weaknesses in Canada right now, is just getting their GDP back up to this pre-COVID level that they've really struggled to do thus far.
Yeah, I think the other thing that's kind of interesting, and I wonder what you think about this. Some of the angst comes from all of those factors happening at the same time, yet the housing market continues to rise.
Mm-hmm.
And that makes people feel insecure,
Yeah.
obviously. So,
It makes people feel insecure. And I mean, bringing it back to the equity picture, the banks in Canada are much more exposed to mortgage loans than
Yes.
the banks in the US.
Yeah.
Their books lean towards residential mortgages. So when concerns about the consumer in Canada, employment, housing costs getting too high, that bleeds into concerns about the banks. Loan loss provisions are really weighing down on these bank profits right now. And Canada's banking sector is seen as pretty well regulated, pretty stable. I mean, they did not suffer nearly as much as the European and the U.S. banking sector in during the Great Financial Crisis.
Oh, for sure. Yeah.
It's a very well regulated system. A lot of prime mortgages on the books. They don't take a lot of risk, and there's really 5 or 6 big banks that operate in that country.
Kind of
Unlike in
easy
the
to
U.S.,
regulate. We have 1,700. No, I'm sorry, more than 5,000, right?
Yeah, it's. I mean, there's a huge number here, but it's. Once concerns about the housing market start to burgeon, you end up with that bleeding into concerns about the banks, and the banks make up a large percentage of the index, and that starts to cause volatility as well. So that's something we're really keeping an eye on to see if these loan loss provisions rising really convert into defaults. As it doesn't seem that way right now. Bankruptcies are still quite low, but it's definitely something to keep an eye on.
Yeah, I mean, this is the thing. It's a pretty long step to delinquency.
Yeah.
And then another long step to default, right? So-
Exactly. And particularly because the banks are so well regulated, are typically lean more towards prime mortgages. These are not people on the brink of collapse financially. So even if home prices go up, even if the employment situation becomes a little bit more difficult, it's not going to be an Armageddon situation the way the 2008 housing bubble burst was.
Right, because there were many more investment properties and all other kinds of things going on then. Yeah, so
Exactly.
and different types of mortgages. Well, let's skip over to Europe for a second because this is also an exceptionally interesting market right now and has more similarities to the U.S. than maybe to Canada. But, it didn't recover all that well from COVID, or I still can't figure out why the U.S. did and Europe didn't. But anyway, maybe we should start there. Where do you think this market is headed?
It's a great question. A lot of investors, I think, are looking towards opportunities outside of the U.S. now. What our models are telling us is that the valuation of the stock 600, that's the main index of Europe, has already priced in a 75 to 100 basis point cut in the next year. So the idea that you could get a bit more of a boost as these cuts start, that's already happened. That in the intermediate term we don't believe is as likely. We're really keeping watch on the earnings situation right now.
Okay.
They have some of the weakest earnings growth really in the developed world across Europe. And a lot of what the market is dependent right now is what we refer to as thematic growth. So growth reliant on artificial intelligence, growth reliant on obesity drugs. Novo Nordisk is now the largest, I have to make sure that's still true as of today, but one of the largest equities in that index. Pharmaceuticals are the largest industry group now.
Yes.
They've exceeded banks.
Yep.
So the idea that Europe is sort of tracking these new trendy ideas around obesity, around AI, even around modern global defense, as we as we enter a more volatile situation in the Middle East with Israel, with Ukraine, Europe is exposed to quite a bit of this. And right now, the earnings expectations for the stock 600 for 2024 earnings growth, they've come down to roughly flat.
Oh, okay.
Analysts were expecting maybe 4 to 5% growth at the beginning of the year, but companies have started to disappoint. But we do see, or at least the consensus expects a bit of a turnaround into 2025, maybe 8 or 9% earnings growth as a result of this. So what could save the European market would be a boost from the thematics that it's exposed to right now over the next year or two, as well as insurance companies perhaps benefiting from a lower rate environment as the ECB cuts.
Okay. I mean, yeah, this is also very difficult to sort of predict in many ways. Well, because, for instance, the whole concept of the European military thing that was bandied around by a couple of prime ministers and presidents really went basically no place. And the UK has been spending some money on some armaments, but it's not the great, the great
not
impetus
as much
to the market.
As,
right?
the US or the military power we have here.
Right. Right. So it's exceptionally, and it's also going to be interesting to see how, I think because that's where a lot of the elections this year are happening. And the French had a totally confusing one.
It was a source of a lot of volatility earlier, definitely in the year. It was one of the largest risks we highlighted going into the second half, was that you could end up with a very conservative government in France, as well as potentially in the UK. And neither of those scenarios played out. And I think that alleviated some of the near-term pressure on those markets, but it's a bit in wait and see if these more liberal policies ultimately weigh on that market in a more negative way. You mentioned earlier, what did the U.S. do that Europe and even Canada didn't do that allowed them to come out of COVID so much stronger? And the answer is really that the U.S. is just a consistently higher labor productivity market. We're able to rebound faster economically as a result of this than countries that have lower labor productivity. And we've seen GDP growth basically normalize in the US. It was negative for several quarters in Germany, just turned positive recently. They're still kind of pulling themselves out of that COVID hole a little bit, or maybe not even the COVID hole, the 2022 slowdown hole. Then the US just has seemed to be quite immune to a lot of this just because of the strength and the productivity of the economy and what we're exposed to. We're a much techier economy, and that tends to ride these waves of economic volatility a bit better.
Isn't the U.S.'s economy a bit more diversified in many respects than Europe, which tends to be sort of a bank drug land, right?
It is. It's much more bank driven, but like I said, the composition of the European index is changing pretty drastically. With the valuation hikes for ASML, with some of these pharmaceutical companies really ratcheting it up. I mean, it's no longer just a bank economy as much. There's a lot of new entry points to the European market, and we're seeing some real potential for growth to come out of those. I mean, Europe, we run a global scorecard that ranks developed market next to one another. And we have Europe coming out really on top, Europe x the UK compared to Canada, Australia, Japan, simply because they're still a relatively cheap market. The earnings situation hasn't deteriorated drastically. Manufacturing is fine. There isn't much great about it, but there isn't much too negative about Europe right now either. Right. And we're waiting to see what happens with earnings and whether these companies can take advantage of some of these latest themes that are starting to crop up.
Okay, great. Well, thank you for being here, Jillian.
Yeah, thanks so much. Thank you for having me.
And thank you all for listening. If you would like and you have a Bloomberg terminal, you can find Jillian and the rest of her coworkers at BI Go. And also, if you're a member of CFA Society New York, you can see Jillian on the video section of our website, when she spoke at the Mid-Year Market Outlook. So until next time, I'm Rob Rowan, and this has been Compound Insights.